Hi, Steve Van Metre here, and welcome to your Wednesday night premiere, where we take about 15 minutes every Monday and Wednesday night to try to make sense of markets. It don't really make any sense, at least not today, but we'll try to figure that out. As you know, Wednesday, the Federal Reserve cut and made emergency cut of the federal funds rate by 50 basis points, taking it down to 1 to 1.25%. Why we have this split rate, I don't know, but that's what we have. And I knew exactly why they did it. In fact, if you've listened to any of my videos in the last couple weeks, you already know the answer. And so I was really curious to see what other people thought of it. And so I turned on a local financial radio show over my lunch break, and I was curious to see what they might say. And I'm not picking on them, because I'm going to tell you how financial advisors and professionals get their advice. They go to the same financial websites you can go to. They read the same headlines, and they regurgitate it. And those headlines are copied from one firm, one company to another, to another, to another, to another, until the consensus is whoever wrote the first headline is right. And the hosts were talking about how the Federal Reserve must know something to do an emergency rate cut, because, well, there would be no reason. Maybe it's the coronavirus. Maybe they know something. No, they don't really know much more than you probably know. Oh, it's got to be the economy. It's got to be they know something about the economy that, boy, we don't know. Well, not really. I mean, okay, do they know more about the economy than we do? Of course they do. But we already know it was slowing in the fourth quarter. We already know the coronavirus is going to have an effect, and it has, are shown in the data. And so they went on and on about there had to be a reason. The Fed knows something we don't know, so they cut. No, that's not why they cut. They cut rates, as I said before, as they would have to, because prior to the cut, 10-year, 7-year, 5-year, 3-year, 2-year, 1-year, and everything under Treasury yield-wise was below 1.5%, which is the lower bound of the federal funds rate. The Fed had inverted the yield curve. They had to cut because banks borrow at short-term rates and lend it long. And when long-term rates are less than short-term rates, you can't make money. They had to cut. And yet, there's such an obvious answer that nobody really saw. So I found that really amusing. Now, I made some notes. I normally don't, but I thought today I needed to due to some of the questions that have come in recently. So now everybody thinks that low interest rates are good for the economy. In fact, the Fed even said, and I love this, they sent some speakers out to say that low interest rates are a sign of confidence in the American economy. Really? That's not true. Is it opposite day? Maybe it is in the Fed world, but it's not true at all. We know famed economist Milton Friedman said the low interest rates were a sign of tight financial conditions. We can validate that. We can, and it's true. So the question is, if low interest rates were a sign of confidence, let's take the other side of the story. Why would somebody in the last couple of days purchase, and there were people who did, a 10-year Treasury bond yielding less than 1%? Is that a sign of confidence that you would lock your money up for 10 years to get paid less than 1% interest? Yeah, it doesn't seem that way, does it? So why would someone buy a 10-year Treasury bond paying 1%? Simple. They believe interest rates are going down. They believe that in the next 6 months, 12 months, couple of years, that people will look back and be like, man, that 1% bond, that was a smart move. Because if interest rates go down, not only do you collect the 1% dividend, but the price of the bond goes up. So why would someone do it? Because they think financial conditions are tightening and are going to get tighter. And when financial conditions get tighter, which direction do interest rates go? Down. I would write interest rates on this, but there might be a day they go up that I'll need to switch colors. So I didn't want to cut some new ones out. So what is amusing to me is the Fed is causing interest rates to go down. What? I know. We've talked about this, but I think it's worth covering these topics again. So how is it possible the Fed is causing interest rates to go down? The Fed has two policy tools. They can buy U.S. Treasury securities and mortgage-backed bonds, or mortgage-backed securities. And number two, they can raise and lower, or they can lower the federal funds rate. They can do the opposite. They can sell and raise too. So they have two tools: buy or sell treasury securities and MBSs, and raise or lower the federal funds rate. Now, to raise and lower the federal funds rate, to raise it, you sell treasury bills. To lower it, you buy them. So effectively, they do the same thing. So if the Fed has to buy T-bills to lower the federal funds rate, I mean, they don't have a switch on the wall. They just go, okay, well, today we'll just computer entry, click the knob over there. It's magic. No, they have to mechanically do something. So think about this. If the Fed is buying 60 billion of T-bills, they've run out, so they have to buy some T-notes. But nevertheless, if they're buying 60 billion of T-bills a month, what are they doing? They're causing interest rates to go down. Aha. So what has been going on? The Fed is lowering interest rates, right? By doing what? Buying T-bills. They lowered them so much, they inverted against the federal funds rate, which I said was a problem. And I said the Fed would need to lower the federal funds rate. So what did the Fed do? They lowered the federal funds rate on Tuesday to uninvert the yield curve. But did they stop buying 60 billion in T-bills a month? No. So guess what? The 10-year Treasury yield today is closed slightly over 1%. Probably by the Fed's meeting in a couple of weeks, it will be under 1%, and the Fed will be again forced to lower rates. So what's happening is the Fed is using its asset purchase program to lower rates, which is forcing it to lower the funds rate, which is causing them to continue lowering rates. And then it's like a dog chasing his tail. It's really funny until you realize how stupid it is. And so you think, man, are the Fed complete idiots? I guess so, because they're lowering rates and then they're in a conundrum. Oh, God, we're going to sign in confidence and interest rates are low. How did they get so low? You did it yourself. You lowered rates, and now you're forced to lower the federal funds rate. So now as an investor, if you want to look like a really smart investor, buy a bunch of treasury securities and sit back and do nothing while your friends laugh at you. Meanwhile, the Fed's doing all the heavy lifting by buying a bunch of T-bills, and as they run out of those, they're forced to buy notes. And when they run out of those, they'll buy some more notes and maybe eventually bonds because they can't figure out why interest rates are going down. And in the end of the day, monetary easing, as we showed on the Monday video, does not lead to financial easing until it does. Now, we actually looked at the mechanism to see that it's not working. And what does it mean by until it does? It means interest rates have to go so low to cause people to flood out of their homes and go buy things, and businesses to go buy things and all do it on credit, that it pumps money out into the economy. Until they're low enough to do that, lower interest rates tighten financial conditions. You know, banks don't want to lend to people at low rates. They don't make much money when people default on low interest rate loans. So what happens when the Fed lowers rates? Financial conditions tighten. Banks tighten their lending standards. And the cycle repeats until the Fed gets rates so low that they're forced to pump the banks full of money, that the banks finally lend because they know they're safe. The same thing happens every time. That's why when people laughed at me when I was buying bonds. They still laughed at me as of weeks ago. People call they think I'm an idiot. How am I an idiot when the largest person with the biggest checkbook, the Federal Reserve, is buying bonds and causing rates to go down and bond prices to go up? Be like, well, when are you going to stop doing that? When they get tired of it? When they drive interest rates negative, I'll probably consider selling. They're going to do that. Yes, they were negative in the last recession. They're going to be deeper negative this time. Well, wait a minute, 10-year Treasury wasn't negative. Right, the federal funds rate was. And so we know the 10-year Treasury is probably going to go negative. And so we look at the markets today. And so be like, well, why did the market go up? Well, it's simple. Market psychology. Look, in long bull markets, right, where stock prices are rising. See, I got the arrow right this direction. Where stock prices are rising. What do people do? They see a dip in stock prices and they buy because they go, okay, is there a dip in the stock prices go down? Yes. Is the Federal Reserve easing? Yes. Then buy. It's like a computer program. If dip in stocks and Fed easing, then buy. Well, have stock prices dipped? Yes, they have. They're not at their all-time high. Is the Fed easing? Yes, they are. So what are people doing? They're buying, but they don't get it. At this stage of the game, the Fed is tightening. And how do we know? Because we talked about it last week, that when stock prices are rising and yields are falling, you get a dislocation. The market doesn't work this way. It should be this way for you. The market doesn't work this way. The monetary system does not work in this direction. They need to go up together or down together, but they do not. This dislocation is a problem. There. I know it doesn't look right. This dislocation is a huge problem. And what is the Fed doing? They're causing rates to go down. So who's going to win the dislocation? The Fed is, just like they did in every single recession that you've been alive to see. And people say it can't happen this time. It's going to happen. Let's take a look at some stuff real quick. Here's a NASDAQ McClellan Summation Index. So you want to know why stocks bounced? Because they got on the cliff of liquidity doom at around minus 300. So investors had to come in to drive stock prices higher. They had no choice. Here's more proof the federal funds rate causes problems. Look, the Fed lowers rates. Look, the job openings and labor turnover survey, former Fed chair Janet Yellen's favorite data on the markets says, look, the Fed cuts rates, which is not showing the recent cut here, causes them to go down. And yes, this is live data. I don't know why it's not shown up yet. How about initial jobless claims? You say, well, I don't see a correlation there. All right, well, let's invert jobless claims so you can see them. And what happens when you lower the federal funds rate? Oh, it causes initial claims to go up and you get a recession. So what is the Fed doing? They're lowering rates because they think that's what needs to happen. They think that lower rates ease financial conditions, but they don't. They tighten them until they ease them. It's crazy, right? Let's take a look at TLT, the largest Treasury ETF. So we're running into what's called resistance up here. What is resistance? Where sellers are at. People say, well, I don't believe in technical analysis. How can you not? It's right here. Here's where sellers are. Here's where sellers are. Let's zoom in and see where sellers are at. Sellers have been right around up here. When it gets up here, sellers come in and sell. It gets up here, they sold. Get over here, they sold. They sold. Buyers are right below here. Who's the buyer in this picture? The Fed and the large commercial banks. Well, how do we know large commercial banks are buying? Well, we look at the data every week, and I'll give you some more data. Today, the weekly mortgage data came out and said new purchase applications fell slightly, but refinance applications shot up. And you go, well, how is that good for bonds? Well, simple. Say you've got a 30-year mortgage and you pay down on it for 15 years and you refinance it. It tells you two important things. One, they're not moving. Number two, it tells them they extended their loan back to 30 years. Oh, how do you know? It's simple. Because in a good economy where incomes are rising, people will refi their house down when rates fall to get to not just to reduce their payment, but they'll partially to reduce the payment, just to accelerate the payoff. We're not in that condition. Rates have not fallen enough for someone, say, with a 15-year mortgage to go in and refi that 15-year to a new 15-year. That doesn't matter. They got to fall a lot more than they have now. So how do we know? Because we know financial conditions are tight. We know that people's income is not keeping up with the economy. And so they're going to go from their 15-year or 20-year, what's left on their mortgage, back to 30. And when they go to 30, what does a bank do? Well, they have to collateralize that mortgage against a 30-year asset. So if they have currently a 20-year or 15-year bond or equal duration of a combination of bonds, they've got to sell those and go out on the curve and pick up some 30 years to back the assets. So what happens is as these refinances are going up, it puts downward pressure on yields, causing the banks to buy them. Pretty cool, right? Pretty cool. Let's take a look at the broad market real quick. And then I want to look at volatility. Here's the Russell 2000. Small caps lead large caps. This, folks, is the closest thing in what you can look at to call a bearish flag. So when prices fall and then they rise kind of this zigzag pattern, it tells you at some point they're going to roll over and head lower. Now, what investors are salivating about is closing this gap up here on the S&P 500. They think that S&P is going to come in here and close it. It might. We'll see what they do. But I want to talk about volatility real quick because volatility is really high. It's up here. And investors are looking at this saying, look, volatility needs to fall, drive stock prices higher. The problem you have here is if you quickly overlay, here we'll go to 13-week Treasury securities and we'll overlay the VIX. What you see is when the Fed drives interest rates down, I don't have the federal funds rate in here. I don't think it exists in here. But when interest rates fall, volatility spikes. So you get, here's the 2000 spike. Here's the last recession, the great financial crisis spike. And look where we're at now when volatility is up here at 31. It's higher than it's been it's almost higher than it was during the dot-com bubble, and it's higher than it was at the onset of the great financial crisis. So what tells me is the Fed could cause a massive flash crash in the economy. You got, in the financial system. I think there's still $3 trillion worth of short volatility. It's over $3 trillion worth of short volatility in the markets out there right now that could flip and come long. This could be the biggest sell-off in the history of the markets. Remember, those jaws will close between yields and stock prices. I'm Steve Van Metre. Thanks for taking the time to watch. We'll be back Friday with our longer weekly economic update. The content of this video is provides educational information only. Is not intended to provide investment or other advice. Material is not to be construed as a recommendation or solicitation by selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in the video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.